Hello friends, good morning. Let us start our CA final direct tax revision. In previous review sessions, we have already discussed about capital gains, profits and gains from business operation. Now we will discuss about income from other sources. When we talk about income from other sources, it will start from the section 56 and it will end with section 59. Section 56 subsection 1, what it says? It says general charge, that is any profits or gains arising from any activity which is not covered, or any income which is arising from any activity which is not covered under any other head of the income tax will be covered under the head income from other sources. This is section 56 subsection 1, general charge. There is section 56 subsection 2, which is specific charge, means specifically the income arising from these activities will be included in only income from other sources only. It will not be included in any other head. Those are, first one is dividend. When you talk about dividend, who will declare the dividend? Just companies will declare the dividend, right? Whether all the type of companies are can declare the dividend, and whatever the dividend that has been declared with all the type of companies will be taxable under income from other sources in the hands of shareholders. Let us talk about it. What type of companies can declare the dividend? Only domestic companies, as per Income Tax Act, only domestic companies which declare the dividend are taxable in the hands of shareholders. So what is the definition of domestic companies? Domestic companies includes two types of companies. Those companies that are incorporated under Companies Act 2013 are called domestic companies, and those companies which have made arrangements for declaration of dividend are also called as domestic companies. Here, one thing you have to remember is those companies, here companies can be either Indian companies or foreign companies. Even Indian companies can make arrangements for declaration of dividend. Even foreign companies which have make arrangements for declaration of dividend, those are also called as domestic companies only. Means if once they are declared as domestic companies, the tax rate applicable for foreign companies is 25% or 30%, as the case may be. And foreign companies can also declare if foreign companies which have not made any arrangements for declaration of dividend, those whatever the dividend that is received from those foreign companies, it will be taxable under respective heads of the individual, under the non-resident taxation. Now let us talk about dividend. What are the types of dividend? There are two types of dividend. There are three types of dividend. First one is final dividend, second one is deemed dividend, third one is interim dividend. Final dividend is taxable in the hands of shareholders in the year in which it is finally declared by the company. Declared, here it is declared in where it will be declared. It will be declared in AGM, annual general meeting. Okay. Now let us talk about interim dividend. Interim dividend is taxable in the year in which it has been received by the shareholder. It is taxable. Now let us talk about deemed dividend. Deemed dividend means the dividend that is taxable in the year in which the company has distributes its assets or accumulated profits, then it will be taxable. So these are the three types of dividend. So when we talk about dividend, let us talk about the taxable rates. Here it is in respect of two types of companies. First one is domestic companies, second one is foreign companies. In case of domestic companies which have made arrangements for which have declared the dividend to the shareholders, it will be taxable in the hands of shareholders only. In respect of foreign companies also, it will be taxable in the hands of shareholders only at normal rates. Normal rates means what? Normal rates are shareholders can be any type of person as per section 2 section 31 or what are the types of persons that are covered there. It will cover all shareholders, cover all the type of persons. So what do based upon the type of person, the tax rates will be available. For example, if the shareholder is an individual, tax rates that are applicable is obviously slab rates that are applicable for the individual. In the similar manner, if the shareholder is partnership firm, tax rates that are applicable is 30%. If the shareholder is association of persons, body of individual, tax rates that are applicable is slab rates, like that. Now we will comes to what if the dividend is if the dividend income is if the total income of the shareholder is exceeds the limits of surcharge, then surcharge will be applicable at the respective rates, and health and education is obviously applicable at the rate of 4%. Here whether there is any dividend loss will be there? No, there will not be any dividend loss. So any other loss can be set off against the dividend. Business loss can be set off against the dividend. House property loss can be set off against the dividend, and other sources, any loss from other sources can be set off against the dividend. But capital gain loss and income from specified businesses and winnings from casual income losses, all these cannot be set off against other sources, other sources income or dividend income, we can say dividend income. Now we will talk about the TDS that is applicable for dividend. Whether TDS is applicable? Yes, TDS is applicable. For whom TDS is applicable? It is applicable for the companies. When the TDS is applicable, TDS is applicable means when the companies has when the Indian companies or domestic companies has declared the dividend, then TDS is applicable. TDS is required to be deducted at the rate of what? At the rate of 10% on the dividend that is declared by the companies. It includes all types of dividends, whether it is final dividend, interim dividend, deemed dividend, or dividend to equity shareholders, dividend to preference shareholders. All types of dividend are covered under section 194, and under section 194 the company is required to deduct TDS at the rate of 10%. If the dividend here limit has been prescribed, when the prescribable limit of dividend exceeds 5,000 rupees, then only company is required to deduct the TDS. If the company has not deducted the TDS, then company will be considered as assessee in case of default under 201 subsection 1, and interest consequences will obviously arises. Interest consequences is what? Interest consequences is 1% per month or part of the month if the TDS is not deducted. If the TDS is deducted but not paid, 1.5% per month or part of the month, as the case may be. Here 1.5% per month or part of the month, as the case may be. If the assessee has included the dividend that has been declared in the total income of the assessee and shareholder and has paid the tax, then as a company will not be treated as assessee in case of default. All these consequences. And what are the due dates for the reduction of TDS is the due dates that are applicable for reduction of TDS in respect of quarterly basis. If it is quarterly basis or monthly basis. In case of dividend, in case of dividend, the dividend will be declared once in a year, right? Once in a year, it will be on monthly basis. In which month the dividend has been declared, next successive month by 7th, it has to be deposited with the government. It has to be deposited with the government. Otherwise, obviously, penal consequences will arise. Next, TDS return that is required to be filed. Yes, TDS return has to be filed. And under section 24, under section which form TDS return is required to be filed? Under section 26Q. Under section 26Q, TDS under section not under form 26Q, TDS return is required to be filed by the company. So now we will come to next. We will come to next part. Next part is what? Next part is deemed dividend. What is deemed dividend? When deemed dividend are covered under section 2 subsection 22 clause A to clause E. When we talk about 2 subsection 22 clause A says like this: if the company has distributed the accumulated profits which entails the distribution of assets of the company, then whatever the distribution that has been carried out from the accumulated profits will be deemed to be considered as dividend that has been declared by the company, or that has been transferred by the company to the shareholders, or distributed by the company to the shareholders, and it will be taxable in the hands of shareholders as deemed dividend. Once it is considered as deemed dividend, company is required to deduct TDS at the rate of 10%, and it will be taxable in the hands of shareholders at normal rates. Here, one thing you have to remember is, what are accumulated profits? Accumulated profits means the profits that are earned by the company, whether it is capitalized or not. Means even from the capital profits also company can declare dividend, or company can distribute capital profits also. Company can distribute revenue profits also. Here profits from up to what date we have to consider profits are available for the company for distribution to the shareholders. So the profits that have been earned up to the date of distribution are considered as distributed profits that are available for distribution to the shareholders. Now we will come to second part. Second part is what? Second part is section 2 subsection 22 clause B. Section 2 subsection 22 clause B says what? Any distribution that has been carried out by the assessee in the form of redemption of debentures or deposit certificates, or in the form of dividend to the preference shareholders, will be considered as deemed dividend in hands of shareholders. Here one thing you have to remember, debentures. When it comes to debentures, not dividend to the preference shareholders, it is bonus shares to the preference shareholders. When it comes to debentures, Debentures are considered as what? Debentures are considered as securities as per securities definition of securities as per Securities Contract Regulation Act, which is adopted by the Income Tax Act also. It is considered as what? Securities. Now, obviously when the company issues debentures, company is required has the liability to pay interest, right? This whatever the interest that has been paid by the company will be allowed as a deduction under 36 subsection 1 clause 3 under Income Tax Act. Here, what is the definition of interest? Interest includes all type of interest, whether it includes commitment charges, it includes any other miscellaneous charges, penal charges, and any other arrangements that have been made for issue of debentures. All these are included in interest. And any expenses that have been incurred on issue of debentures, including convertible debentures, are allowed as reduction under section 37. In the similar manner, when we comes to debentures, or who are the debenture holders that have been invested in the debentures, for them it will be considered as what? It will be considered as capital asset. Once it is considered as capital asset, any capital gain arising from capital asset, it will be taxable under the head income capital gains. In respect of capital gains, whatever the sale consideration that will be received, it is considered as full value of consideration, and cost of acquisition is whatever the investment that has been made by the shareholders in the company. Here the indexation benefit is available for debentures. No, indexation benefit is not available for debentures. It is not available for debentures. So consider cost, say full value of consideration minus cost of acquisition, we will get net capital gain. This net capital gain has to be taxable at the normal rates. What are the rates that are applicable for this? Depending upon period of holding, whether it is considered as securities, shares and securities, yet it is considered shares and securities. Means the period of holding will be what? Period of holding here is 12 months. So if it is more than 12 months, it is considered as long-term capital gain under section 2 subsection 29 capital A, 2 subsection 29 capital A, and 2 subsection 29 capital B. It is considered as long-term capital gain, and it is taxable at the rate of 20. If those are unlisted, if the debentures are listed, then we can say it will be covered under 112A, and no, not 112A. It will be covered under 112, and it will be taxable at the rate of 20%. If it is whether listed or unlisted debentures, if it is short-term capital gain, it will be taxable at the rate of what? It will be taxable at the rate of 30%. And in the similar manner, any long-term capital gain or any long-term capital loss arising from debentures can be set off against long-term capital gain from the debentures, and any short-term capital loss arising from debentures, transfer of debentures, will be covered under long-term capital gain. If the debentures are converted into equity shares, it will not be considered as transfer under section 47. So no capital gain will arise. When the equity shares are sold, then the capital gain will arise. Whether the company will issue bonus debentures? No, there is no option that is available for the company, because debentures are considered as liability for the company, not the capital. So it will not be company does not have any option to issue bonus debentures. In the similar manner, when we comes to second part, it is deposit certificates. Deposit certificates are also considered as liability for the company. Any interest that has been paid on deposit certificates are also considered as securities. And whatever the provisions that are applicable for debentures, it will also applicable for deposit certificates also. And any interest that has been paid on deposit certificates, and interest tedious consequences will also arise in case of interest that has been paid to the debentures under section 194 capital A. Interest other than interest on securities, interest on securities, into 193, sorry, section 193, TDS has to be deducted at the rate of 10% if the interest amount exceeds 15,000 rupees. In the similar manner, deposit certificates also, TDS has to be deducted at the rate of 10% if the limit exceeds 50,000 rupees. If the amount paid as the interest exceeds 15,000 rupees. In the similar manner, when it comes to deposit certificates, interest is required to be deducted at the rate of interest is required to be deducted from the PGVP income under section 36 subsection 1 clause 3, and any issue expenses that have been incurred by the company on issue of deposit certificates, this will be considered as revenue expenditure only. It will be allowed a deduction under section 37. In the similar manner, it will be taxable in the hands of shareholders under income from other sources only. Income from other sources, interest that has been received on deposit certificates will be allowed as reduction under income from other sources under section 56. It will be taxable in the hands of shareholders and income from other sources. And in the similar manner, any income from other sources. In the similar manner, any expenses that have been reasonably incurred for earning of this income, it will be allowed a reduction under section 57. Now we will comes to bonus shares to preference shareholders. So bonus shares is very interesting concept. Bonus shares can be issued to equity shareholders, it can be issued to preference shareholders. Equity shares and preference shares. When bonus shares are issued to equity shares, then in that situation, what are the consequences that will arise? Any issue expenses that have been incurred on issue of bonus shares will be allowed a reduction under section 37 subsection 1, and in the similar manner any issue expenses that has been incurred on issue of equity shares or preference shares will also allow a reduction under 37 subsection 1. In the similar manner, when the bonus shares are issued by the company to the shareholders, it will be considered as capital asset in the hands of shareholders, and we have taxability arises in two cases. First case is if the bonus shares are issued before 1/4/2001 or bonus shares are issued after 1/4/2001. If the bonus shares are issued by the company before 1/4/2001, then in that situations whatever cost of acquisition will be considered as the fair market value of bonus shares on 1/4/2001, and full value of consideration minus cost of acquisition will be considered as capital gain, and depending upon the type of shares, whether they are listed shares or unlisted shares, taxability will arise at the rate of 10% or 20% as the case may be, and if it is short-term capital gain 15% or 30% as the case may be, 111A or normal capital gain. When it comes to bonus shares to preference shareholders, any bonus shares that have been issued to preference shareholders, it will be considered as deemed dividend, and it will be taxable under income from other sources only. No capital gain. It will be taxable under income from other sources in the hands of company, and in the hands of income from other sources in the hands of shareholders, and it will not it will not be covered under capital gains, because preference shares are not considered as capital asset. Are not considered as capital asset, because securities definition will not include preference shares under income tax under Securities Contract Regulation Act 1951. In the similar manner, when we comes to any any bonus shares that are issued by the company to the equity shareholders, it will not be considered as a deemed dividend. When we comes to section 2 section 22 clause C, that is any profit that the company has distributed the accumulated profits in the case of liquidation of the company to the shareholders, then it will be considered as deemed dividend. Here, liquidation of in the case of liquidation of the company, the accumulated profits up to the date of liquidation will be considered as considered for the purpose of distribution, and it will be considered as deemed dividend in the hands of shareholders, and it will be taxable at normal tax rates. And 2 section 24 section 224 clause D is any profits that have been distributed by the company or accumulated profits that have been distributed by the company to the shareholders on account of reduction of share capital of the company, it will also be considered as what? It will also be considered as deemed dividend, and it will be considered as deemed dividend, and it will be taxable in the hands of shareholders at normal tax rates. And 2 section 22 clause E is special type of section. This subsection covers what any loan or advances that have been made by the company, closely held companies to the shareholders. Whether loans or advances can be made to all shareholders, no. Here also the specified category or specified eligibility that have been prescribed. Who are eligible for obtaining of loans and advances from the closely held companies? Those shareholders who are having at least 10% of the voting share in the company or beneficial interest in the company, or those shareholders that are having at least substantial interest of 20% in the income of the company, then those shareholders are eligible for obtaining of loans and advances. Any loans and advances made by the closely held companies to its shareholders will be considered as deemed dividend. If those loans and advances are made from accumulated profits only, it will be considered as deemed dividend. If those loans and advances are not made from accumulated profits, it will not be considered as deemed dividend. So in the hands of shareholders, it will be taxable at normal tax rates. Now here, whether all the loans and advances made by the company will be considered as deemed dividend? No. If the loans and advances made by the company, exception to section 2 section 22 clause E is two exceptions. One is if the loans and advances made by the company in the ordinary course of business, then it will not be considered as deemed dividend. Second one is if the company has declared the dividend, and dividend has been set off against the deemed dividend that has been previously declared as deemed dividend, then the adjusted amount will not be again considered as deemed dividend, will not be taxable as deemed dividend. These are two exceptions to section 2 section 22 clause E. Next, what are the three cases where whatever the distribution that has been made cannot be considered as deemed dividend. Those are, first one is if the company has made arrangements for the buyback of shares, then it will not be considered as deemed dividend, because in respect of buyback of shares, why it is not considered as deemed dividend means buyback of shares is nothing but repayment of capital. Repayment in respect of repayment of capital, it is not doing from the accumulated profits, or it can be due from the accumulated profits. It can be done from the whatever the cash reserves that are available with the company, and company will be taxable at the rate of 23.296 or 294% of tax rate, that is 20% of tax rate plus 12% of surcharge plus 4% of health and educational cess, and it will be exempt in the hands of shareholders. In the similar manner, in the similar way, any distribution that has been made by the company to the non-participating preference shares, or any amount that has been paid to the non-participating preference shares will not be considered as dividend paid by the company. And next, here foreign companies can also pay dividend, right? We have seen in the beginning of the session, foreign companies can also pay dividend. If the Indian companies, section 115 BVD, what it tells, say under section 115 BBD, if the Indian companies has made arrangements for receiving of dividend from the foreign companies, then it will be taxable at the concessional rate of 15% on gross basis without deduction of any expenses against that income under section 115 BBD. This option is available for the Indian companies only, and it is available only if the Indian companies having the specified interest of more than or equal to 26% from the in the foreign companies, then only this option is available. Now we'll discuss about if the Indian companies having less than or equal to 26% of the voting power or voting share or interest in the foreign companies, then for those Indian companies, it will be taxable on an income from other sources only, and tax rates at the rate of 25% or 30%, as the case may be, will be applicable, and normal surcharge rates will be applicable, and any brought forward losses relating to PGBP or relating to house property or relating to other sources can be set off against the dividend. Can be set off against the dividend, because the dividend is taxable at the rate of normal rates. If the company has opted for section 115 BBDA, 115 BBA, 115 BAB, then in that situations, whether this dividend is taxable at the rate of normal rates, or whether this dividend is taxable at the rate of special rates, or it will be taxable at the rate of normal rates. If the company has opted for section 115 BAA, BAB, if those companies that are not having a specified interest in the foreign companies, that is less than 26%, then those companies will be taxable at the rate of 22% of tax plus 10% of surcharge plus 4% of health and expenses in case of 115 BAA. 115 BAB companies, this will be taxable at the rate of same rate only, because it is not considered as manufacturing income from manufacturing activities. So it will be taxable at the rate of 22% of tax plus 10% of surcharge plus 4% of health and expenses. And in a similar manner, when we comes to section 115 BAA, BAB companies, those companies which has a specified interest in the foreign companies, it will be taxable at the rate of what? It will be taxable at the rate of concessional rate of 15% is available? No, concessional rate of 15% is not available. It is taxable at the rate of 22% of tax rate plus 10% of surcharge plus 4% of health and expenses. Special rate is available at the rate of 15%. 15% is available in respect of this dividend. Now we will comes to what? We will come to section 56 subsection 2 clause 56 subsection 2 clause B. Clause B is what? Clause B is casual income. Casual income consists of two kinds of income, that is section 115B, section 115BB. Section 115B consists of income arising from card games, crossword puzzles, winnings from card games, crossword puzzles, lotteries, betting, gambling are covered under section 115B. 115BB consists of winnings arising from owning and maintaining of race horses. race horses. So tax rate that is applicable for these two types of incomes is 30%, and TDS under 194B or 194BB is applicable, and TDS is deducted at the rate of 30% plus 30% in respect of and here the limit that is available is 10,000 rupees. If the income exceeds 10,000 rupees, only TDS is required to be deducted. And in respect of winnings from owning and maintaining of race horses, any losses that are arising from these winnings cannot be set off against the winnings against the credits. Only after paying the TDS to the government, remaining amount is available for set off against the debits, and net amount has to be paid by the person who is managing the activity to the person who has win the amount on account of winning from race horses, on account of participating in race horse. In a similar manner, it is taxable at the rate of 30%. TDS is required to be deducted at the rate of 30%, and obviously normal TDS is required to be paid on monthly basis by 7th of next month, and TDS has to be deducted and paid to the government, and TDS return is required to be filed under 26Q. In the similar manner, what is the quarterly return? Quarterly return will be filed to the government by 30th June, obviously 30th June, 31st August, 30th September, 31st October, 30th December, 31st January, and 31st March. It is 31st May. 31st May is available for filing of TDS returns. If TDS returns is not furnished within the due date, then 200 rupees per day penalty will be applicable for companies, for the entities which have not filed TDS returns within the time. Next, we will comes to section 194BB, right? Section 194B, 194BB. Next, we will go to third type of income, that is any income that is arising relating to excess amount that have been issued, exceeding the fair market value of securities that have been issued by the company, or shares that have been issued by the company, will be treated as income, and it will be taxable under the head income from other sources. So when we come to fair market value of shares, what is fair market value? Fair market value, how we have to determine fair market value? Fair market value has to be determined under the Rule 11 UA. As per Rule 11 UA, it is A plus B plus A plus A minus L into PV divided by PE. That is, A is nothing but total value of all the assets excluding any taxes that have been paid relating to advance tax, TDS, TCS, income tax has to be reduced, and any deferred tax expenses will be reduced. Now we will from the remaining assets will be available, and from this we have to reduce liabilities. Excludes equity share capital reserves and unascertained provision for unascertained liabilities, provision for loss of subsidiaries, provision for income tax, and provision for contingent liabilities has to be reduced. Then we will get net assets. From net assets we have to multiply it with PV. PV is nothing but paid up value of capital, paid up value of equity share capital divided by PE is paid up value of equity share capital. Then we will get the proportionate amount, which is the fair market value. From the total issue price minus fair market value, we will get the excess amount which will be considered as securities premium. It will be taxable under income from other sources. Under section 56 subsection 2 clause 7b. Now any income that has been arising on account of interest on compensation or enhanced compensation, where we have seen this one, section 45 subsection 2 capital A, I think so, or section which is an exception to section compulsory acquisition, on account of compulsory acquisition, section 45 subsection 4, I think so, yes, 4, section 45 subsection 5 or 5 capital A joint development agreement, 5, I think section 45 subsection 5. Any compensation arising from compulsory acquisition of capital asset will be taxable under income from other income from capital gains, and any interest arising from compensation or enhanced compensation, it will be taxable under income from other sources. And this against this interest income, under section 57, 50% of the income received will be available for deduction under section 57. Now we will go to any income that is arising from any family pension that has been received by the assessee will be included under income from other sources, and any amount that has been received from by the MP or MLAs or MLCs other than salaries will be included under income from other sources, and any interest income, uh, any interest income on any securities will be included under income from other sources. It will not, if it is not taxable under any other head, and any any compensation that has been received on termination of employment of the assessee, which is paid by any other person but not the employer. If it is paid by the employer, it will be taxable under the head salaries under 17 subsection 1. If it is paid by any other person, it will be taxable under income from other sources on account of termination of the employment to the if it is paid to the assessee. It will be under section 56 subsection 2 clause 11, section 56 subsection 2 clause 9. Clause 9 deals with what? Clause 9 deals with any section 56 subsection 2 clause 9 we will discuss later. Section 56 subsection 2 clause 10 is what? Clause 10 is which is very in gift taxation. Gift taxation is any sum of money that has been paid or any value of property that have been transferred to the assessee by way of by which for no consideration or for inadequate consideration, then it will be taxable under the head income from other sources. So here two things happens. First one is section 56 subsection 2 clause 10 is divided into categories. First category is in respect of sum of money that has been paid in respect of immoved property. When we talk about property in terms of sum of money that has been paid, if the sum of money that has been paid exceeds 50,000 rupees, aggregate of sum of money that has been paid to the assessee for no consideration exceeds 50,000 rupees, then entire sum is taxable under the head income from other sources. If the sum of money that has been paid to the assessee for inadequate there will not be any inadequate consideration. There is only one case here. Second case in respect of property. Property, it is divided into three categories. First category is what? First category is movable property. Second category is immovable property. When we discuss about movable property, if the movable property has been transferred by the assessee to the other person for no consideration, then in that situation, if the fair market value of that movable property exceeds 50,000 rupees, then entire fair market value is taxable under the head income from other sources. What is fair market value here? Fair market value, what is movable property? We have to know. What is movable property? Movable property includes shares and securities. Movable properties includes jewelry, paintings, sculptures, drawings, paintings, sculptures, work of art, or archaeological collections, any other work of art. It also includes stock in trade. It also includes any other type of movable property will be included in the definition of movable property. Next, what is the fair market value? How we have to determine the fair market value in respect of movable property? Here, in respect of jewelry, this is divided into three categories. First one is jewelry. It is nothing but value that has been determined by the valuation officer. It is open market value. If it is jewelry, if it is less than 50,000 rupees, if it is greater than 50,000 rupees. If the value is less than 50,000 rupees, it will be open market value. We have to take the open market value. If the value is greater than 50,000 rupees, then the value determined by the valuation officer will be considered as a fair market value. If the assessee has purchased the jewelry and it has been transferred to another person, then in that situation, purchase price is considered as a fair market value. When it comes to drawings, paintings, sculptures, work of art, archaeological collections, and in respect of all these categories, it is also divided into three categories. Is in the similar manner how we will determine the fair market value of jewelry, we will determine the fair market value of these also. If the value is less than 50,000 rupees, then we will take it as open market value. If the value is greater than 50,000 rupees, value determined by the valuation officer will be considered as fair market value. If it has been purchased by the assessee and it has been transferred, then purchase price will be considered as open fair market value. When it comes to third one is relating to shares and securities. Shares are divided into two categories: listed equity shares and listed equity shares. Listed equity shares which are transferred through recognized stock exchange, listed equity shares which are transferred through off market terms, and unlisted equity shares. When it comes to listed equity shares, here the value that is tradable on the recognized stock exchange will be considered for the purpose of open market value. In respect of listed equity shares that are transferred on off market terms, so the lowest value on the date will be considered as the fair market value. When it comes to unlisted equity shares, valuation will be done as per Rule 11 UA, where the Rule 11 UA it also comes under section 50C. Section 50 CA. Section 50 CA, unquoted shares. Any capital gain arising from transfer of unquoted shares and unquoted shares or unlisted shares. In the similar manner, here also for determining cost of acquisition, there we have used Rule 11 UA. Here also we will use Rule 11 UA. Rule 11 UA is what in respect of Section 50 B also. Slum sale also we will use same category of valuation. Rule 11 UA. What is here A plus B plus C plus D minus L into PV divided by PE. Here A is nothing but what? A is nothing but the value of all the assets, excluding the assets, excluding any taxes that have been paid, any provision for income, any taxes that have been paid, any deferred tax expenses, deferred tax income will be reduced from A. Then we will get what is B. B is nothing but the value of jewelry. Value of jewelry will be considered. C is nothing but value of shares and securities. Fair market value of shares and securities will be considered. D is nothing but D is nothing but value of immovable property, stamp duty value is considered, and minus L. L is nothing but liabilities. Liabilities excludes what? Liabilities excludes equity share capital. It excludes share capital. It excludes shares and what we say reserves. It excludes reserves. It excludes provision for loss of subsidy, provision for uncertain liabilities, provision for contingent liabilities, and provision for income tax will be included. Provision for income tax will be included into PV divided by PE. That is nothing but paid up value of capital divided by paid up value of equity share. Paid up value of equity share capital divided by paid up value of capital. Then we will get what? We will get the proportionate value is considered as fair market value. Fair market value. This fair market value is considered for the purpose of determination. Here, if in respect of immovable property, now we are seeing movable property, right? Movable property. Now we will go to what? We will go to immovable property. Immovable property is divided into two categories. First one is immovable property which has been transferred for no consideration. Immovable property that has been transferred for inadequate consideration. If it has been transferred for no consideration, then the stamp duty value of immovable property will be considered as if the stamp duty value exceeds 50,000 rupees, then the entire stamp duty value will be taxable under the head income from other sources. Here stamp duty value, when we discuss when we get the word stamp duty value, then we will immediately strike the section 50C, section 43C in case of PGVP, in case of capital gain section 50C. That is, if the date of agreement and the date of registration are not same, then in that situation, if any amount in the form of other than cash that is in the electronic mode has been received, or electronic mode has been received by the assessee, then the stamp duty value and the date of registration will be considered as date of agreement will be considered as full value of consideration. Then if it is in other case, the stamp duty value and the date of registration will be considered full value of consideration. Means in respect of other sources, what stamp duty value will be considered? Stamp duty value and the date of agreement will be considered for the purpose of comparing it with 50,000 rupees. If the stamp duty value on the date of agreement is exceeding 50,000 rupees, entire stamp duty value on the date of agreement will be considered as will be taxable under the head other sources. In the similar manner, if it has not satisfied, if any advance amount has not been received, then the stamp duty value on the date of registration will be considered. If the stamp duty value on the date of registration exceeds 50,000 rupees, entire stamp duty value will be taxable under the head income from other sources. Income from other sources. Now under section 43 CA also same thing will be repeated under section 43 CA. Now if the reference has been made to valuation officer, then in that situation, if the valuation officer has determined the value of the property which is less than the stamp duty value, which is greater than stamp duty value. If it is less than stamp duty value, then value determined by the valuation officer will be considered for the purpose of taxability. Means value determined by the valuation officer for the property, if its value exceeds 50,000 rupees, then entire value will be taxable under the head income from other sources. So if the value determined by the valuation officer is more than stamp duty value, then stamp duty value will be considered for the purpose of taxability, and stamp duty value, if it exceeds 50,000 rupees, the entire stamp duty value will be considered as a full value of considered for the taxable under the head income from other sources. So now if the immovable property has been transferred for inadequate consideration, in that situation, the difference between actual consideration, inadequate consideration minus inadequate consideration minus higher of the following two, that is 10% of the consideration, or 50,000 rupees, whichever is higher. If it exceeds 50,000 rupees, whichever is higher. If it exceeds 50,000, the difference amount exceeds 50,000 rupees, and entire amount will be taxable under the head income from other sources. So if the difference amount is less than 50,000 rupees, then it is not taxable. Here the one thing here, property can be commercial property, can be property can be residential property. If it is residential property, then higher limit of 20% is available for residential property. For commercial property, limit is 10% of the 10% of the property only available. Now we will go to whether the section 56 section 2 clause 10 is applicable in all cases. No, it will not be applicable in certain cases. So those are when we comes to when the transfer has been made to the relative, and when the transfer has been made on account of the will or on account of will or irrevocable trust, or on account of succession, or when the transfer has been made to the fund or trust or organization or foundation or university or medical institution or educational institution, or if the transfer has been made to a local authority, if the transfer has been made to the made under section 12AA or to the entity which has taken registration under the 10 section 23C clause 6 clause 5 clause 6 clause 4 clause 5 clause 6 clause 6A, or if the transfer has been made to entity that has taken registration under 12AA, 12AA, 12AB, 12A, 12AA, 12AB, and if the to the entities the transfer has been covered under section 47 series, that is section 47 1 2 3 4 5 6A 6B 6D 6D 6A 6B 6C 6D and 7AA 7AB 7AC 7AD 7AE 7AF, and if it has been covered under section if it is covered under if it has been covered if it is related to the medical expenditure on account of COVID-19, if it is covered, or any amount that has been received on account of relief under COVID-19, if it is received from any other person, if it is received from the employer, if it is received from any other person or employer, if the amount exceeds 10,000 rupees, 10 lakh rupees, then it will be taxed. It will be covered under the exceptions of 56 of subsection 2 clause 10, and any amount that has been in respect of trust related transfers, that is transfer has been made to the foundation of the trust, or it has been made under 12AA or 12AB or 12A, then in these two cases, if the transfer has been made for the benefit of owner or founder of the trust or any relative of the trust who has a substantial interest in the trust, then in that situation it will be covered under 13 subsection 3, and it will be taxable 56 subsection 2 clause 10 will be applicable in this case. If it is not covered under above category, then only 56 subsection 2 clause 10 is not applicable, and 56 subsection 2 clause 10 is not applicable. And in respect of any transfer that has been made, any transfer that has been made to made on account of death of the person, it will not be covered under 56 subsection 2 clause 10. And here, what is the definition of relative definition includes spouse of the person, spouse of the assessee. It includes brothers, sisters, spouses of brothers and sisters, and parents, including spouses of parents, parents and lineal ascendant and descendant, and spouses of lineal ascendant and descendant will be included in the definition of relative. And it also includes spouses of persons that have been mentioned under 2 to 6 of above, means previously we mentioned persons are there. Now from 2 to 6 also those spouses also will be considered as relatives only. So section 50 subsection 2 clause 10 will not be applicable for all these type of persons. So whatever the transfer that has been made, it will be not considered. It will be not considered if any asset that have been received on account of demerger, or amalgamation will not be considered as a transfer. 50 subsection 2 clause 10 is not applicable. When we goes to section 50 subsection 2 clause 9, clause 9, and remaining sections we will discuss later. Parts we will discuss later. Now we will comes to section 56 complete. Section 57 is what? 57 is related to deduction of expenses, deductions that are available from income from other sources. So this includes following. First one is any interest that has been earned in respect of section 56, one point we have forgot. Any rental income that is arising from the plant and machinery, on renting of plant and machinery or furniture or equipment or movable property will be if it is not taxable under any other under PGVP, it will be taxable under income from other sources, and it will be taxable under income from other sources, and any purposes that have been provided by the employer, it will be taxable. If it is not taxable under their salaries, it will be taxable under their income from other sources, and in the similar manner, any rent from immovable property which is not taxable under the head under the respective head, it will be taxable under income from other sources. In the similar manner, let us come to deductions. Interest that has been received. If the interest that has been received on securities, or dividend that has been received on shares or units of UTI, then whatever the expenses that has been any interest expense that has been incurred by the assessee in earning of this dividend, then entire interest income is not allowed as deduction. It is limited to 20% of the income that has been earned by the assessee. Remaining interest will not be allowed as deduction. It will be allowed as deduction under respective PGVP income. It will be allowed as deduction. Next, it will not be allowed a reduction under the head salary, under the head income from other sources. In a similar manner, any reasonable expenses that have been incurred by the assessee, relating to earning of income relating to interest income or dividend income or any other income, then it will be allowed a deduction against respective income. And third one is any family pension that has been received by the assessee, and deduction that is available is 1/3 of the family pension received or 15,000 rupees, whichever is lower is allowed a reduction. Taxability of family pension will not be available in respect of two cases, that is, it is received by the armed forces or persons relating to military or air force or navy will this pension will be exempt under section 10. And in the similar manner, if the pension has been received by the person who has received by the family members of the person who has received Paramveer Chakra, Veer Chakra or Bharat Ratna, all these category of persons, whatever the pension that is received, or Veer Chakra, obviously Veer Chakra, and it will be those persons, it will be exempt under section 10. Now we will go to any expenses that has been incurred, that is repair expenses or any maintenance expenses, repair expenses, and any insurance that have been paid by the assessee on account of plant and machinery or furniture or removed property where the rental income is taxable under the head income from other sources, then these expenses are allowed for deduction against that income. Next, any other income that has been taxable under the head income from other sources, any reasonable expenses that has been incurred, these reasonable expenses are allowed as deduction. Now, next, what are the there are section 58 deals with the income that are not taxable under the head income from or expenses that are not allowed a deduction under income from other sources. So first one is personal expenses are not allowed a deduction. Next, any interest that has been paid to non-resident where it is received outside India and TDS has not been deducted under has not been deducted under section 193 or 194 capital A, as a case may be. Then entire income will be 100% of such income will be disallowed, and it will not be allowed a deduction under section 58. If it is not covered under, if the assessee does not have PGVP income, then under other sources it will not be allowed as deduction under section 58. In the similar manner, if the person has paid salaries and the no TDS has been deducted under section 192, then the salaries are received by the person assessee from a place outside India, then in that situation these salaries are 100% of salaries paid to the person will be allowed as disallowed, and it will not be allowed a deduction. And if the person does not have any PGVP income, then obviously from income from other sources it will not be allowed a deduction. Next, in the similar manner, if the person has made any expenses to the non-resident from a source from a resident source, and no TDS has been deducted, then 30% of such expenditure is disallowed. 30% of the expenditure is disallowed under section 40A 1A 1B, as a case may be. If the assessee does not have any PGVP income, then 30% of such income is disallowed under income from other sources. Next, in respect of these are the expenses that are not allowed as deduction from income from other sources. Section 58. Section 59 deals with what deemed income category. Under section if the assessee has PGVP income under section 41 subsection 3, any remission or cessation of trading liability that has been made earlier and any income that has been received on remission or cessation of trading liability, that income that has been received will be taxable in the year as deemed income in the year in which the amount has been received by the assessee. In the similar manner, if the assessee does not have PGVP income, then if any not it need not be any trading liability, it can be any other liability that have been remitted or any cessation or remission of any liability previously happened and or bad debts that have been written off, and in the subsequent years any amount that have been realized on account of that liability that is previously remitted or previously cessed, then it will be taxable. It will be considered as deemed income. It will be taxable under income from other sources. This is section 59. So this is entirely income from other sources. Now we'll go to what? We'll go to some case laws. That is, for one case law is Kanju and Co. Supreme Court judgment. What is it? What is if there are unsold lottery tickets that have been available with the person who is selling the lottery tickets, and if any prize that have been won from the unsold lottery tickets, then it will not be taxable under the income from capital PGVP. It will be taxable under the income from other sources, and it will be taxable at the rate of 30%. It will be taxable at the rate of 30%. Now, this is one of the case law. Mostly these are the important cases that we have to remember. Now we'll go to this is a completion of what other sources. So now we'll go to taxation of in case of political parties and electoral trust. We'll discuss first taxation of political parties. Political parties. What is political party? Political party means a entity that have been registered under section 29 capital A of Representation of Peoples Act 1951. Then it is considered as political party. So we will discuss about taxability of political parties. So first thing is, in respect of political parties, 4 types of income is not taxable. That is, income from house property, income from capital gains, income from other sources, and voluntary contributions that have been received by the political parties are exempt from tax. Means if they are exempt from tax, means it will not be included in total income. It will not be included. There is the difference between reduction and exemption. Exemption means it will not be included in total income at all. Reduction is it will be included in total income. It will be allowed a reduction. It will be allowed a reduction. That is reduction. Exemption means the income will not be included. Income will not be included in total income at all. It is exempt, and PGVP income is taxable in the hands of political parties. In order to claim this exemption under section 13 capital A, some of the conditions that need to be satisfied. Political party is required to maintain books of accounts which enables the assessing officer to allow deductions, and political party is required to get its books of accounts audited from the chartered accountant and has to submit the audit report, and political party is required to file its registration of income under 139 subsection 4 capital B within the due date prescribed, and political parties any contribution that has been received by the political party, voluntary contribution that has been received by the political parties, if it is exceeding 2,000 rupees, then it has to be received by way of account paycheck or account pay demand after electronic clearing system through bank account or any other electronic mode. If it is any other electronic mode, and political party has to, if the political party satisfied all these conditions, then exemptions are available in respect of income from house property, capital gain, other sources, and voluntary contributions in respect of political parties under section 13 capital A. This is when we discuss about taxability of political parties, any income arising to the political party, that is PGVP income, is taxable at normal rates. Means for political parties it is covered under individual slab category. So slab rate is available for political parties also. So up to 2,50,000 rupees slab rate tax rate is nil. 2,50,000 rupees to 5 lakh rupees, so tax rate is 5%. 5 lakh rupees to 10 lakh rupees tax rate is 20%. 5 lakh rupees to 10 lakh rupees tax rate is 20%. If it exceeds 10 lakh rupees, the tax rate is 30%. If it exceeds 10 lakh rupees, tax rate is 30%. And surcharges that are applicable for political parties is also same. That is, if the total income is up to 50 lakh rupees, no surcharge. If the total income exceeds 50 lakh rupees, but up to If the total income is exceeds 50 lakh rupees, but up to 1 crore rupees, surcharge rate is 10%. If the total income exceeds 1 crore rupees, but up to 2 crore rupees, surcharge rate is 15%. And total income exceeds 2 crore rupees, but up to 5 crore rupees, surcharge rate is 25%. If the total income exceeds 5 crore rupees, surcharge rate is 37%. Whether the optional scheme under 115 BAC will be applicable for political parties? No, it will be applicable for only individuals only. Whether higher basic exemption limit is available for political parties? No, it will be available for only individuals only, resident individuals only. And obviously political parties will be resident political they will in respect of political party there will be non-resident, and the political parties are required to receive the contributions from only Indian sources only. It cannot receive contributions from foreign sources, and this is taxability in respect of political parties. Now we will go to taxation of electoral trust. What is electoral trust? Electoral trust is a company, non-profit company that have been registered under section 25 of the Companies Act 1956 or section 8 of Companies Act 2013. Is the electoral trust. This electoral trust, in respect of electoral trust, what is the taxability that arises? Electoral trust is required to distribute 95% of minimum 95% of its total receipts to the political parties under 13th capital A, then only 35 capital A, and remaining the political parties, the electoral trust, what it can do, electoral trust can make arrangements for managing the affairs of political electoral trust. It can expend in the year of incorporation in the subsequent in the year of incorporation maximum 5 lakh rupees, 5% of the total receipts or 5 lakh rupees, whichever is higher can be expended by the electoral trust as the expenses for maintenance or managing the affairs of electoral trust in the year of incorporation. In the subsequent years, it can expend maximum of 5 lakh rupees, that is 5 lakh rupees, 5% or 3 lakh rupees, whichever is higher can be expended by the political electoral trust. And electoral trust is also required to maintain books of accounts, and electoral trust is required to maintain the records of all voluntary contributions received by the person. Voluntary contribution can be received from resident individual, it can be received from non-resident individual and non-resident individual. Here, if the voluntary contributions are received from resident individual, then it has to maintain the records of name of the person, permanent account number of the person, mobile number of the person, and address of the person, and all the remaining details. In respect of non-resident individual, additional details that have to be maintained by the political parties is relating to passport number is also required to be mentioned. And whether companies can do contributions to political electoral trust? Yes, it can do contributions to electoral trust. What are the deductions that are available under section 80 GGB, 80 GGC, under section 80 GGB, under section yes, wait one thing. Yeah. In respect of electoral trust, there are two types of deductions that are available for companies and for other assessees. If the contribution has been made by the companies, Indian companies, then deduction is available under section 80 GGB. Whatever the contribution that has been made, 100% of the contributions will be allowed at deduction. If it is for other assessees, 80 GGC is available. Whatever the contribution that has been made by the other assessees, then it will be allowed as 100%. 100% of such contribution is allowed at deduction under section 80 GGC. In the similar way, any in case of electoral trust also, any contribution that has been received excess of 2,000 rupees, it has to be received by account pay check or account pay demand draft or electronic clearing system through bank account or any other electronic mode. And if it is exceeding and it has to maintain the records of what are the four sources where the electoral trust cannot receive contributions. It cannot receive any contributions from the foreign source. It cannot receive any contributions from the foreign government. It cannot receive any contributions from the person who is not related to India, means who is not a resident of India or non-resident category. Also, he cannot be. It cannot receive not from other categories, and it cannot receive contributions. It cannot receive contributions from any entities or any associations which are located outside India. It cannot receive contributions. So this is taxation of electoral trust. Now we will go to we'll discuss about what? We'll discuss about charitable trust and charitable and religious trust. Here, charitable and religious trust. Here, there are two regimes in this case. First one is 10 section 23C regime and section 11 to section 13 regime. When we discuss about 10 section 23C regime, here. What are the types of institutions that are covered here? Type of institutions that are covered here are any educational institution, any medical institution, any university, any university, any fund or any association will be covered under 10 section 23C. 23C. Here let us discuss about exemptions that are available under section 10 section 23C for all these categories. So first thing, in order to discuss about exemption under the 10 section 23C, it will be divided into following categories. First category is if they are substantially financed by the government, if they are substantially financed by the government in respect of educational institution, in respect of medical institution, if they are substantially financed by the government. What is substantially financed by the government? Means the total receipts from the educational institution or medical institution, out of the total receipts of educational institution or medical institution, more than 50% of the receipts are received from the government, then we can say that it is substantially financed by the government. If they are substantially financed by the government, 10 section 23C exemption is available in respect of these two, medical institution and educational institution. Now in respect of receipts that are less than 5 crore rupees, if the receipts are less than 5 crore rupees in respect of medical institution and educational institution, exemption under 10 section 23C is available. Exemption under 10 section 23C is available in respect of receipts greater than 5 crore rupees in respect of medical institution and educational institution. Exemption under 10 section 23C is not available. In respect of any in respect of approval, the approval is required to be obtained from the assessing officer in respect of receipts that are less than 5 crore rupees in respect of educational institution, medical institution. In respect of any any public any government in respect of the entities which are entities who wholly charitable trusts and wholly charitable and religious trusts, where whose charitable activities are mandatory or required by the government, and in those categories exemption under 10 section 23 is available. 23C is available based upon the approval. The approval has to be obtained, mandatory approval has to be obtained from the relevant authority. Then only exemption under section 10 section 23C is available. Now will comes to what will comes to registration of these entities. Here previous in the before here 1/4/2021, before 1/4/2021, after 1/4/2021, what is the approval process? Approval process is the first the educational institution or medical institution or any university or any association has to make an application to the assessing officer, that is Commissioner of Income Tax, Commissioner of Income Tax or Principal Commissioner of Income Tax, and the Commissioner of Income Tax or Principal Commissioner of Income Tax, after obtaining relevant information or relevant records and after making relevant inquiries, it will grant its approval, and approval will be received by the educational institution or medical institution or university as the case may be. And after 1/4/2021, the registration process has completely changed. Approval process has been completely changed. First provision to section 10 section 23C clause 1, that is any approval that has been received by the educational institution or medical institution or university or as the case may be prior to 1/4/2021, those persons has to make an application to the Commissioner of Income Tax or Principal Commissioner of Income Tax within 3 months from 1/4/2021. From 1/4/2021, it has to make an application in Form 10A. Then once the application has been received by the Principal Commissioner of Income Tax or Commissioner of Income Tax, then it will grant its approval within 30 days from the end of the month in which application has been received. And what is the validity period of that approval? Approval validity period is what? Approval validity period is 5 years. 5 years, and from which date this will be comes to applicability. It will be comes to applicability from the assessment year, relevant assessment year, from the where where the entities, that is university or educational institution, medical institution, has got approval in the previous regime, the previous prior to 1/4/2021. From that date, relevant assessment onwards, applicability will continue like that only. In the similar manner, let us discuss about 10 section 23C. First provision to 10 section 23C, clause 2. Clause 2 is related to what? Clause 2 is related to renewal process. That is, if the entity has obtained registration, approval from under section 10 section 23C from the Commission of Income Tax or Commission of Income Tax, and the period of 5 years has been lapsed. Means the university or educational institution or medical institution which has got approval under section 10 section 23C and the period of 5 years has lapsed, then in that situation it can again make an application for renewal of approval, and this application has to be made. What is the time period for making of application? Application has to be made within 6 months prior to the expiry of period of 5 years, 5 years as the case may be, and it has to make an application in form 10 in the form 10AB, and it has to make an application. In form 10AB. Once it has made an application, then once application has been received, the Principal Commissioner of Income Tax or Commissioner of Income Tax has to submit its approval or provide its approval under section provides approval within the period of 6 months from the end of the month in which application has been received, and from the end of the month in which application has been received. In respect, application has been received, and what is the time limit? Application has been received after inquiring 4 things, that is genuineness of activities and obtaining relevant records and information, and third one is after obtaining relevant records and information, and third one is after satisfying itself that the entity has been formed for genuine purposes only. If the assessing officer is satisfied, it will grant approval. If the assessing officer is not satisfied, it will reject the application, and it will cancel the approval after giving reasonable opportunity of being heard. And in respect of what is the validity period? Validity period is from the financial year from the assessment year following the financial year in which the application has been made. Approval will get affected. Next, first project to section 10 section 23C, clause 3 is what? Clause 3 is related to those entities which have that is university, medical institution, educational institution, which have got approval provisionally from the Commission of Income Tax or Principal Commission of Income Tax, has to make an application for final approval. This application has to be made. In respect of at least 6 months prior to the expiry of provisional approval, which is granted by the Principal Commission of Income Tax or Commission of Income Tax. Application has to be made. The application has to be made in form 10AA, and when the application has been made, the Principal Commission of Income Tax or Commission of Income Tax will grant its approval within 6 months, within 30 days from the end of the month in which application has been made. Once it has been satisfied that the entity has formed for genuine purposes only, and entity has submitted all the records and documents, whatever the call for, and has made relevant inquiries that have been made, and if it is satisfied, it will grant approval. If it is not satisfied, it will reject the approval, and cancel the approval and reject the application, cancel the approval, and after giving reasonable opportunity of being heard. If once the approval has been granted, then it will be affected from the assessment year following the previous year in which the provisional approval has been granted. Following provisional approval has been affected from that relevant assessment year, the approval, the final approval will get affected. Next, in respect of the entities, in all other cases, first project to 10 section 23C clause 4. In all other cases, what happens? In all other cases, the entity that is has to make an application within the period of 30 days from the end. Within a period of 30 days, it has to make an application in form 10 capital A to the Principal Commission of Income Tax or Commission of Income Tax. Principal Commission of Income Tax or Commission of Income Tax will grant its approval within 30 days from the end of the month in which application has been received. And what is the validity period in respect of renewal? In respect of final approval, validity period is 5 years. In respect of it will grant approval on provisional basis. So if it is satisfied, it will grant approval on provisional basis. The validity period of approval is 3 years. Provisional approval is 3 years, and once the provisional approval has been, the provisional approval will get affected from the assessment year from which the application has been made, from the relevant to the previous year from which the application has been made. It will get affected. It will get affected. So this is the registration process relating to 10 section 23C. Relating to 10 section 23C, the entities can make an application to the application for approval under for exemption under 10 section 23C. Now we'll go to in order to claim exemption under 10 section 23C, what are the conditions that need to be satisfied. First condition is 15% of accumulation. The entities has to make a 15% accumulation of income that has been earned during the previous year, and this 15% accumulation, it can make more than accumulation of more than 15%, but this whatever the amount excess of 15% that has been accumulated, that accumulated income can be accumulated for a period of 5 years only, maximum 5 years only, and these entities has to invest these accumulated income in the mode specified under 11 subsection 5. In the mode specified under 11 subsection 5, there are 4 cases where the amount that has been accumulated need not be invested in 11 subsection 5 mode. Those are, first one is if the assets have been formed part of corpus from 1983 onwards. From 1983 onwards, then there is no need to invest these accumulation in the mode prescribed under 11 subsection 5. In the similar manner, if the assets being the equity shares of the company of a company which have been forming part of assets of the universities or medical institution, educational institution which are forming part of corpus from 1978 onwards, from 1998 onwards, then 1993 onwards, then there is no need of accumulation. If the assets forming part of corpus from 1973 onwards, then there is no need to invest in 11 subsection 5 modes. 11 subsection 5 modes in all these categories, there is no need to invest in 11 subsection 5 modes. Next, here the income of the entities which who got exemption under 10 section 23C does not include any contribution that have been received in respect of forming part of corpus. Means it also includes any contribution that has been received in a specific direction, that this amount has to be utilized for the specific activity or specific purpose only. It should form part of corpus. It should not form part of income of the fund or educational institution, medical institution, or university. Next, in the similar manner, if the university or medical institution, educational institution has any business receipts or business income or income taxable under their PGVP, then in that situation, the income will be exempt. That income will be exempt if separate books of accounts are maintained. It will be considered as normal income only. Exemption under the 10 section 23C will not be removed. If there is a limit for this, that is it should be 20% of such 20% of the total receipts. So it should not exceed 20% of the total receipts. So if there exceeds 20% of the total receipts, then exemption under 10 section 23C will be removed for that year only, but not entirely cancelled. It will be removed for that year only. For the next year, it may be awarded if the total receipts are less than 20%. 20% of the total, if the total income from PGVP is less than 20% of the total receipts, so the activities should be related to incidental to the income. If they are incidental to the main activities, then 20% limit is not available. If they are not incidental to the main activities, then 20% limit is applicable. 20% limit is applicable. Let us clarify this point also. I have also doubt in this point. Now, in respect of all other categories of exemption that are available is here, if anonymous donations that are received by the educational institution or medical institution or university, these anonymous donations are taxable under section 115 BBC. Limit that is available is 1 lakh rupees or 15% of the 5% of total donations are 1 lakh rupees. Whichever is higher will be taxable at normal rates, and remaining amount will be taxable at 30% of tax. 30% of tax here under section 115 BBC. Here total donations include three types of donations: voluntary donations, corpus donations, and anonymous donations. Anonymous donations are included in total donations. And all of the remaining provisions that are applicable for charitable and religious trusts will be applicable for anonymous donations also. So all of the remaining provisions we will discuss in charitable and religious trusts chapter when we comes to the charitable and religious trust topic. So this is entirely related to 10 section 23C regime. Then we will go to next regime, that is section 11 to section 13. We will discuss further afterwards. So thank you for patience listening. Have a nice day. Bye.